Ja, okay.
It's Umar Agagan Chat.
Okay, good morning, everyone. How are you doing today? Okay, so welcome to our first online class. I think we're still waiting for some students to log in. In terms of the register, Microsoft Teams does it automatically, and therefore we can use that as our official register, right? The meeting is also recorded and transcribed. Are you guys able to see if someone is in the lobby or not? And are you able to admit someone in the lobby? Okay, I'm just waiting for more students to log in. In the meantime, I'm just going to open up our slides, so at least we're ready to go from that perspective. And okay, brilliant, 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 brilliant. There we go. I think this works better than trying to use Blackboard. Can everyone see my screen? The slides with Global Securities Operations. Are you able to see the slides, guys? Okay, perfect. So what can you see on your screen? Can you see the slides and the notes or just the slides? Just the slides. Okay, perfect. Can you see the notes? I don't like this thing where it makes admitting and all of that. That's very annoying. Okay, guys, you know what? I think we need to be a bit careful about our cameras. Okay, so as I said yesterday, we are going to skip as I said yesterday, we are going to skip the calculation part of fixed income for now, and we're going to carry on to not warrants. We're going to go on to collective investment vehicles. Okay, so what are CIVs? Who can tell me what's a CIV? So you can talk on this thing. You don't have to hide away. Okay, so you don't have to hide away. You can open up your camera so you can be part of our beautiful lecture venue. And you can talk. So you can raise your hand if you have a question, as well as ask a question in the Q&A or in the chat room. So that is what options you have as members. So what are CIVs? Who would like to tell me what's a CIV? Does no one know? Okay, we need to start working together here because I can't give you all the answers. You need to give me all the answers as well. What is a CIV? Oh, we missed one actually. Let's go depository receipts. Let's start there. Okay. Okay, so to kick off the class, what I would like everyone to do is what I would like to inform everyone is that I'm not sure if you saw my message yesterday, but I had a request from the class to move the online class to Thursday. I'm sorry, the online class to Wednesday and the face-to-face class on Thursday. And the reason this is because you have an accounting online class on Wednesday and an accounting physical class on Thursday. So I thought I'll just make it easier for everyone, and therefore we can yeah, and therefore we can make it easier for you as a student. Okay, so does that work for everyone? Yes or no? Just let me know. So you'll see I'm going to put up a poll, and it's going to say, does Wednesday online Okay, so you should get a poll now, and you can answer it if it works for you. In the meantime, we're going to talk about depository receipts. I can actually see what's happening here. Okay, so what is a depository receipt? A depository receipt is a financial instrument that mirrors the shares of a foreign company. Okay. So it's not an actual share of that foreign company, but it's a mirror. So an example of this could be if you're a South African company and you listed on the stock exchange, there might be an investment bank in the United Kingdom that says, oh, this company does well. Let's try to sell these shares in the UK in pounds and on the secondary market there. So instead of me as the company having to go and list there, I can actually, the investment company can create a depository receipt and just list it on the stock exchange. So in other words, it's like being able to buy a foreign company, but you're buying it in your local currency. And you're not actually buying the share from the actual share, you're buying a mirror of the share, a reflection of the share. So that's what a mirror is, right? Okay, so that is what a reflection is. It's a mirror, and it's basically copying that. So if the original share gives a dividend in the local country that it's listed, then those same entitlements will go to the mirrored share or the depository receipt. So you get two types of depository receipts. You get a global repository receipt. Oh, what the heck? You get a global one, and you get an American depository receipt. Now, in effect, they're exactly the same thing. It's just because it's American, we need to actually put the word American in there. So an American depository receipt is issued in the United States, in United States dollar. And the reason that we do a depository receipt is the reduction of costs and risks associated with investing in non-US companies. So what is important and that you do need to remember is for a depository receipt to be valid, the investment bank that launches it needs to purchase that shares in the original country and then sort of almost resells it in the foreign country. So all ADRs, American Depository Receipts, must comply with the Security Exchange Commission rules, including full registration and reporting requirements. So here's an example of a US bank. So a US investment bank purchases 10 shares in the UK company British Land on the London Stock Exchange. Then the New York NYC Bank registers the shares with the SEC to market the ADR in New York. So once it's approved, it can be sold on the New York Stock Exchange. So in essence, the British Land ADR is a repackaged British Land share backed by the British Land ordinary shares that are owned on the New York Stock by the NYC Investment Bank. So they'll trade in US dollars, they'll pay the dividend in US dollars, and that makes it easy for everyone to invest in those shares. So NYC will set up an arrangement with a custodian bank for the latter to act as a depository bank for the ADRs. So you have to work through a custodian bank, and the underlying shares have to be deposited with that custodian bank. Dividends will be given in US dollars in direct proportion of what they received in the original holding. And after that, once it trades, you can do secondary trading of those ADRs. So the reason that we do a ADR, so you have two types of investments, okay? So if I wanted to invest in shares in the United Kingdom, I'll have to buy those shares as foreign shares in the United Kingdom. Alternatively, if there's an ADR in my local exchange, I can rather buy the ADR. And the reasons that we do this is sometimes with foreign shares, there are ownership restrictions. So some stock exchanges or countries don't allow foreigners to own shares in that don't allow foreigners to hold shares, to own shares in that country. And because of an ADR, you're not subject to those ownership restrictions because the shares still stay in that original country. In terms of settlement procedures, it's much easier to settle a DR because it's on the local exchange versus trying to settle something in the UK or in a foreign country, because the settlement cycle will become very long and inefficient. Shares have to be for foreign shares, they need to be paid in the foreign currency, whereas with the depositary receipt, it will be paid in the local currency. Dividend payments for foreign shares paid in foreign currency, and for a dividend depositary receipt will be paid in the local currency. Now, here's one of the weaknesses of a DR. So for rights issues and corporate actions, if you own the foreign share, you can participate in all of those corporate actions and rights and all of that. But with a DR, you are not necessarily given the right to receive any corporate actions, but it depends on the depository agreement. Liquidity, sometimes there's a lack of liquidity in the foreign market, but in the local markets, they are more liquid. Transfer taxes, so some countries have high transfer taxes if you're foreign and trying to buy their shares, whereas a depository receipt should be a bit cheaper. And the legal framework, that's the last one. So with regards to legal framework, so if you're investing in a foreign country, say you're investing in Sudan, you're buying shares in Sudan, it makes sense to you do not have the same regulation as a developed financial market. Whereas in the ADR, in a local market, you can be more trusting of that regulation that you will receive. Okay, and then there is something called a pre-release facility. So in some circumstances, you can actually sell the ADR before the ordinary shares have been deposited, and that's called pre-release. But there are certain rules to do that, and there are 4 rules. So the DR issuer verifies in writing that it owns those shares. The pre-release is fully collateralized with cash or other acceptable collateral. The depository is able to close out the pre-release within a specified notice period, and other indemnities need to be provided. So a global depository receipt, as I said, allows issuers to raise capital in 2 or more markets simultaneously. So you can try to raise funds in different markets, different exchanges. And that is the end of depository receipts. Okay. So I'm going to change our view to the gallery view. Gather mode. Okay. So can everyone see the weird looking lecture venue? Can everyone see the very odd looking lecture venue? Okay, it might be, okay. So if you can imagine a lecture venue where we sit every day, the CIV is taking everyone in that lecture venue, pooling all of their money together and buying shares. So if I told everyone in this room to give me 100 Rand, or if I told everyone in this room today to take 5,000 Rand and invest it in the stock exchange, would you be able to do that? Most likely not. Okay. But if I told you to give me 100 Rand so that we can combine it, so that we can get to 5,000 Rand and then invest it in the stock exchange, we would most likely be able to do that. To afford 100 Rand is much easier than affording 5,000 Rand. So that is what a CIV is all about. It's a collective investment vehicle. So collective means that it's part of a group of people. Investment, okay, investment vehicle. A vehicle means a company, a trust, some sort of entity. So collective investment vehicle, and that is what a CIV is. So instead of investing directly in those financial instruments, you can invest through a CIV. Now, at some point, once you stop university, you will be able to start earning money, and money will be taken off your salary if you get a job, and that will go to a pension fund. So a pension fund is also a type of collective investment vehicle. And why is that? Because all the employees in your company will then put money together. It goes into a huge pension fund, and the pension fund buys either properties, they buy shares, they buy bonds, and all of these fancy things. And when you retire, they'll give you some of those returns. So if you're looking at a collective investment vehicle, you get, in essence, two types. The first one is actively, and the second one is passively. So if you look at this meeting we have right now, I'm the active person because I'm busy, I'm talking, I'm thinking, and you guys are passive as you're sitting and back and you're listening and you're seeing what to do. But you're not talking, you're not opening a video and all of those kind of things. So I'm active, they're passive, or you guys are passive. And similar with the CIV, you get actively managed as well as passively managed. So an actively managed unit trust or CIV means that you have a team of trained individuals called the fund managers, and they are attempting to outperform their peer group. So they are working all the time trying to create the best returns for the fund members. Passive funds would rather track an index. So it uses computer algorithms to actually say, we just want to get top 10 shares, the return on the top 10 shares of the JSE, and it would then buy and sell based on those rules. Okay, so that is that. All right. So you have two categories. Usually an actively managed fund would have higher fees because no one's doing this for free. So an actively managed fund will have higher fees, whereas a passively managed fund will be cheaper and easier to buy. And why would the actively managed fund have higher fees? Because you have a team. You have a team of people with a lot of knowledge, skills, high qualifications, stuff like that, that gives them the ability to beat the market. So if you want to learn more about these type of products, you can just go to any fund manager's website, and on there they'll have fund fact sheets. And on the fund fact sheet is where you'll be able to learn about these different type of funds. If I'm not mistaken, the assignment might include doing something like that, researching funds and what they do and how much money they make and stuff like that. Okay. So mutual funds. So the first type of CIV we're going to look at is a mutual fund or a unit trust. And a unit trust is a trust formed to manage securities on behalf of investors that offers the combined benefits of diversification and sufficient weight of assets to ensure cost effectiveness. So in essence, this fund will use the investor's money to buy shares or other instruments, and then it will issue units in the underlying portfolio. It's open-ended. So open-ended means that the manager can create new units when new investors subscribe. So as more money comes into the fund, we can create new units and resell those units. And then the price of the units changes depending on the asset value of that fund. So those fund managers can sell the units on to other investors, or if no one wants to buy it, they can use, they'll sell the underlying shares and use cash to meet the cost of redemptions if someone needs to exit the fund. Obviously, the fund managers charge a commission on the units sold, and the price at which a fund manager sells a unit to a retail investor will be higher than the price to which a fund manager will buy from a retail investor. So you get a bid and offer price, and there is a spread in between the two. So that is what a mutual fund is, or unit trust is. And if I'm not mistaken, one of our students has purchased unit trusts already. So I hope that they do very well in their investments. And another reason why we'd go for using a unit trust over share or buying directly is, I mean, as students at the university, most people, I would say 90 to 95% of the working class of people have no idea how to invest correctly in the stock exchange. And if you use a unit trust, you're taking advantage of someone else's knowledge to get better returns. Okay, the next one we're looking at is an open-ended investment company, OEICs. And these are another type of CIV, which are very similar to a unit trust. The major difference is that an OIC is an open investment company, not a trust. Therefore, they issue shares rather than units. So a trust will issue units and a company will issue shares. So similarly, the price per share is based on the assets that the company owns. But in this way, the OEIC quotes a single price for buying and selling shares, not like how a trust works with a bid and offer price. So open-ended means that as money flows in or out of the fund manager can create or cancel existing shares in order to meet investor demand. So OICs registered in, okay, so you get the ones in France are called SICAV, in Belgium, France, and Luxembourg, but it's the same thing as an OEIC. Then you get exchange traded products. So under exchange traded products, you get a few different ones, and essentially it is traded on the stock exchange. The ETP holds assets such as stocks or bonds, and trades at approximately the same price as its net asset value. Okay, so not much higher or much lower. And they are very attractive because of their low cost, because they're not actively managed, because they are tax efficient, and they are very similar to buying normal shares, except that you gain from the diversification benefits. The first one we're going to look at is an ETF. So that exchange traded funds allow an investor to buy an entire basket of stocks through a single security that tracks the returns of the stock market. For example, you can buy an FTSE 100 or an S&P 500 or a JSE Top 40 or a JSE Mining Index. And it's a special type of index mutual funds. So it's very easy to buy, and anyone here in the room can buy them right now without having deep knowledge, the need for deep knowledge or the expense of high fees. So what is nice is that they trade on a major exchange during the day, just like an ordinary stock. Whereas the other types, the value only gets looked at once a day, usually at the market's closed, and the units are only repriced daily, whereas the ETF is repriced all the time. Because ETFs trade on an exchange, their prices are determined by market demand for the ETF shares. So sometimes they might be bought at a discount or a premium to the net asset value. And the next one we're going to look at is called the ETN. So it's exchange traded notes, and this is similar to an ETF, but it's not for a basket of shares, rather it's for debt securities. So it is for senior unsecured, unsubordinated debt securities with a maturity date and backed only by the credit of the issuer. So when an investor buys an ETN, the underwriting bank promises to pay the amount reflected in the index minus fees upon maturity. They are linked to a return on the benchmark index, but they do not actually own anything because they are only tracking. So this type of instrument is fully exposed to the risk of the issuer. And they are much higher risk than normal debt instruments. And then you get exchange traded commodities, and that is similar to the ETNs and ETFs, but instead of tracking a share or a debt instrument, it tracks a commodity. So what is a commodity? A commodity is anything you can buy that is standardized. So an example of a commodity is 24 karat gold. So whether you buy 24 karat gold in South Africa, or you buy it in the Congo, or you buy it in China, or you buy it anywhere else, 24 karat gold will be 24 karat gold. Same with most of your metals, all your metals, you get precious metals and non-precious metals. Your other standardized things could be stuff like maize. Okay, so you can buy 1 bushel of white maize or 1 bushel of yellow maize, stuff like that. And those are commodities. So standardized products, oil is a commodity. Yeah. Okay, so it doesn't matter where you're buying it from, as long as the standard is the same, it will have the same price. Okay, I'm going to give us a 2-minute break just to grab some water, stand up, stretch, and then we will return to class after that. Okay, so I hope everyone had a good stretch and we can get ready to continue with our CIVs. There's not much more to cover today, but let's finish the section. Okay, so the next type of CIV is called an investment trust. So even though the name says investment trust, it's not actually a trust, but it's a company whose business is to invest in the shares of other companies, like unit trust and OEICs. So investment trust pool investors' money to employ a professional fund manager to invest in the shares of a wide range of companies. Now, I'll just give you a bit of advice quickly, or a bit of insight quickly, is I'm sure you've been to the different shopping centers in South Africa, like Sandton or Eastgate or Westgate or Southgate, all of those type of shopping centers. And who do you think owns those shopping centers? So those shopping centers are owned by, usually by Liberty Company, the company called Liberty. And what they do is they build these huge shopping centers and they take the returns from the rental returns and use that to continue growing the pension fund. So most shopping centers in South Africa are actually owned by pension funds. Okay, so as I was saying, investment trust. So here they closed-ended. So the number of shares the trust issues, the money it raises is fixed from the start. So you cannot add more shares or more units into that type of trust. So that makes it different to the other ones you spoke about in the previous slide. The pricing methodology is determined by the stock market. So it can be at a discount or premium to the underlying shares. You can get different classes of shares. And these are called split capital investment trusts. So some pay higher dividends, some only give dividends, and some only give capital gain, which is quite weird. So if you want to invest only in capital gain because you're younger, this is a good option for you. They have an independent board of directors, which means they are the company is listed, and therefore the directors have to look after the interests of the shareholders. And the last one is gearing, which is very important. So they can borrow money to purchase additional assets. So they can go to a bank, take out a loan and buy more assets for their as part of their investment strategy. Hedge funds. So I'm sure you guys have heard about hedge funds. It's very exciting in the financial world. Hedge funds are high risk where people make a lot of money and all of those things. So they come in many shapes and sizes. So they also pool investors' money and employ a professional fund manager to invest this. They employ a range of investment strategies to make money in rising or falling market conditions. Okay. So they use very many different strategies. And because they are a hedge fund, they can engage in using derivatives like short selling instruments. They buy. So a short position says that the investor sells an instrument on the premise that it is overvalued, or bad news will be expected and the price will fall down. So I'll sell it today at a higher price and buy tomorrow at a lower price. So they use that to make large profits, but they can also make large losses. They have different regulations as compared to mutual funds and stuff like that, but that's because they need to inform the investors of the higher risks that are experienced. So if you look here, they use other strategies and you need to know these type of strategies, right? So the first one apart from short selling, the next one is distressed securities. So if they see a company that is facing bankruptcy or some issue on the market, then they can react quickly. They can buy all the shares in their company, take control of it, and turn it around. Then the special situations. So if there's a merger, a hostile takeover, a leverage buyout, whatever it might be, so they buy them and hope to take advantage of that difference between the current market price and the ultimate purchase price of the company. And we can use arbitrage. So arbitrage is trying to exploit inefficiencies in the market. So by trading a hedge portfolio of offsetting long and short positions, so you get convertible arbitrage. So you can buy a convertible bond, and when it gets converted to shares, you can sell it for a higher price. You get fixed income arbitrage and statistical arbitrage. Okay. This is just an example of an investment trust. So you can see an investment trust is there, and then it owns unit trusts or other OEICs. And this is your fund value is £3 billion. The share price is 4.45 pence. The leverage is 7%, meaning they have 7% debt, and the net asset value is 468. So in this example here, it's actually cheaper to buy this fund than to buy those same shares. So it's selling at a discount. Okay, and the last three we're going to look at from CIVs. The first one is a real estate investment trust. So these are also listed investment trusts, but their focus is only pooling money to buy property and property assets. Then the gain comes from the rental income. So they buy not only shopping centers, they buy corporate spaces, they can buy residential spaces. So there's lots of ways they can buy stuff. Because it's very difficult for one person to raise enough money to buy an entire property, but we all want to get exposure to those returns. Private equity funds. These are also one of the more sexy type of investment funds. And these are not publicly traded, but they are a group of investors that raise funds. These funds will then be used to buy a company that is cheaper than what it is, and they then change the company, improve the management team, and eventually the aim is to get them to list. And once they list, they make a lot of money. Okay, so they have different strategies, and you also have something called a venture capital fund, which tries to develop emerging companies. So they purchase an equity stake in the company and they try to grow it and then sell it off. Tax transparent funds. These were brought in on the 1st of July 2013 to bring the UK in line with the other European fund centers. And the reason is they can take advantage of some of the tax benefits in the UK versus the other European countries. Then the last section of collective investment schemes is cryptocurrencies. I'm sure we've all heard about cryptocurrencies before. So it's a new type, or relatively new type of investment scheme using blockchain technology. Bitcoin was the first one. And currently, I think over the past week, it almost reached 1 million Rand. So if you bought Bitcoin in 2015 for $350, is now trading at something like $50,000. So can you imagine, you would have made $49,000 profit. So Bitcoin is unregulated and is quite an issue for investments. But there is a regulation trying to take advantage of it, or rather take control of it. But because it is decentralized, not controlled by anyone specifically, it becomes very difficult. Okay, so that's all for today. I think it's been a long day, a lot of theory. You need to know these different types of funds, how they work and what they do, what's the special features of each fund, because those are type of questions you can expect to get in the exam. So I'm going to take a list of attendance. So I've downloaded the attendance register, so whoever was here show on that attendance register. The meeting is recorded, so I can put that up online for you to review if you need to, and that's it. Before I leave, I'd like to say, can I please upload the slides? Okay, so I'll upload the slides for chapter 1 up until where we've finished today. And what I would like you guys to do is ask any other questions. But what we're going to do is from next week, we're going to change. So Wednesday will be next week, Wednesday will be an online class again. And then Thursday will be face-to-face. So Wednesday will continue with theory, and Thursday we'll start working on those wonderful, wonderful calculations. I'll upload the slides today. Happiness. Okay, you should get access to them probably within the next 20 minutes or so. Okay, thank you and have a good day. Don't forget, you need to be consistent in your studying. If you watch the video I sent yesterday on the group, it talks about the Pomodoro method. If you download the app on your phone, it's called Pomodoro method. And in essence, it gives you a study method that helps to optimize and efficientize your studying time. So you work for 25 minutes, take a 5-minute break, go outside, go in the sun, jump up and down, do something fun that distracts you from work, but you be very strict with yourself. So you're using a timer, and then you come back, work for another 25 minutes, take a 5-minute break. And doing those 4 or 5 times in a row will give you a much higher output than actually trying to do everything in 5 hours straight. Okay, so good luck. Send me a WhatsApp if you need anything, and thank you. You may leave.